Why most investors lose money. Almost every investor has had this moment. You buy a stock because everyone says it's a great opportunity. For a few days, it goes up, and you feel like you're finally getting the hang of investing. Then it drops. You tell yourself not to panic, but somehow you keep checking the price anyway. One more time, then again, and before you realize it, you're making decisions based on fear, hope, and headlines instead of logic. Years ago, Warren Buffett said something that sounds almost too simple. Be fearful when others are greedy, and greedy when others are fearful. Millions of people have heard that quote. Very few actually understand it, because Buffett wasn't just talking about being contrarian. He was describing the biggest reason why most investors never build lasting wealth. Most people believe Warren Buffett became successful because he knew which stocks to buy. That's the story everyone remembers, but it isn't the lesson that made him one of the greatest investors in history. If that were true, Wall Street should be full of Warren Buffetts. The world's biggest investment firms have more analysts, faster information, and billions of dollars to invest, yet very few have matched what Buffett achieved over 6 decades. So maybe we've been asking the wrong question. Instead of asking, what stock would Warren Buffett buy today, maybe we should be asking, what did Warren Buffett understand about investing that most people still don't? Because once you see that lesson, you won't just look at Warren Buffett differently. You'll look at every investment decision differently. And the surprising part is, it all began with a mistake Buffett himself made long before he became the investor the world knows today. Chapter 1. Warren Buffett's first big investing mistake. Long before Warren Buffett became one of the greatest investors in history, before Berkshire Hathaway, before Coca-Cola, he was just a young man obsessed with numbers. As a teenager, Buffett wasn't searching for the world's greatest businesses. He was searching for bargains. Anything that looked incredibly cheap immediately caught his attention. And to be fair, he wasn't guessing. He had been heavily influenced by Benjamin Graham, the legendary investor often called the father of value investing. Graham taught something incredibly logical. If you could buy $1 for 50 cents, sooner or later the market would recognize its true value. It was a strategy built on mathematics, discipline, and patience. For a young investor like Buffett, it made perfect sense. So he started looking for companies that almost nobody wanted. Businesses trading below what they were actually worth. Old manufacturing companies, struggling textile businesses. Companies that looked ugly on the surface but were statistically cheap. Years later, Buffett compared these investments to finding a discarded cigar butt on the street. It might have one more puff left, but that last puff was free. That's exactly how he viewed many investments. Buy them cheap, wait for the market to notice, sell them, repeat. And for a while, it worked. His returns were impressive. His confidence grew. From the outside, it looked like he had already figured out the secret to investing. But beneath those numbers, a problem was quietly growing. Because buying something simply because it's cheap isn't the same as buying something that's truly valuable. Think about how often we make the exact same mistake today. A stock falls 40%. Suddenly, people start calling it a bargain. Not because the business improved, but simply because the price is lower than it used to be. Our brains naturally confuse a lower price with a better opportunity. Retail stores train us to think that way. If your favorite pair of shoes is 50% off, it's probably a great deal. But the stock market doesn't work like a shopping mall. Sometimes a stock is cheaper because the business itself is becoming weaker. And sometimes the biggest risk isn't paying too much, it's buying something that deserves to be cheap. This is one of the psychological traps that catches millions of investors. The lower the price falls, the more attractive it appears. Not because the facts changed, but because our minds anchor to the old price and assume we're getting a discount. Buffett eventually realized that price alone could never answer the most important investing question. What is this business actually worth? That sounds obvious today, but at the time, it completely changed the direction of his career. Because he slowly discovered that focusing only on cheap companies often forced him to own average businesses. and average businesses create average results, even if you buy them at great prices. That realization didn't happen overnight. It happened because someone challenged one of the beliefs Buffett had trusted for years. It wasn't an argument. It wasn't a market crash. It was a conversation with someone who looked at investing through an entirely different lens. And once Buffett accepted that new way of thinking, the businesses he bought, and eventually the fortune he built, would never be the same again. Chapter 2. The Conversation That Changed Everything. The person who challenged Warren Buffett's thinking wasn't another famous investor. It was Charlie Munger. At first, Buffett wasn't convinced. Why would he be? His strategy was working. He had studied under Benjamin Graham, one of the greatest investing minds of all time. He had results. And changing a strategy that's already making money is one of the hardest things anyone can do. Not just in investing, in life. But Munger kept coming back to one simple idea. He believed Buffett was solving the wrong problem. Instead of asking, how cheap is this company? He believed the better question was, how good is this business? That might sound like a small difference. It wasn't. It completely changed the way Buffett looked at investing. Munger argued that an outstanding business could keep creating value year after year. A mediocre business couldn't, even if you bought it at a bargain price. A business that's constantly forced to fight competitors, cut prices, and struggle just to survive might be cheap to buy, but every year it has to work just to stay alive. A business people genuinely love is different. It can raise prices without losing customers, earn strong profits year after year, and rarely gets replaced by competitors. Even if you pay a little more for it today, what happens over the next 10 or 20 years can be dramatically different. That idea slowly started changing Buffett's mind, and then came one investment that proved Munger was right. In 1972, Berkshire Hathaway acquired See's Candies. On paper, it didn't look like the type of business young Buffett would have chased years earlier. It wasn't unbelievably cheap. It wasn't selling for pennies on the dollar. In fact, Berkshire paid about $25 million for the company, even though its tangible assets were worth much less. To the younger Buffett, that would have seemed expensive, but Munger saw something Buffett had been overlooking. People didn't buy See's Candies because sugar and chocolate were unique. They bought it because they trusted the brand. Every holiday, every birthday, customers came back, not because it was the cheapest option, because it meant something to them. That meant See's could gradually raise prices without losing loyal customers. Its greatest asset wasn't sitting on the balance sheet. It existed in the minds of its customers. That realization was powerful. Buffett later acknowledged that Munger had fundamentally changed the way he invested. Instead of searching for statistically cheap companies, he began looking for exceptional businesses with durable advantages. That shift sounds obvious today, but at the time it completely changed Berkshire Hathaway's future. It also explains why Buffett eventually invested in companies like Coca-Cola, Apple, and American Express, not because they were always the cheapest stocks, but because they owned something far more valuable than a low price. At this point, you might think that's the lesson. Buy great businesses instead of cheap ones. It's an important lesson, but it still isn't Buffett's biggest investing lesson, because even among great businesses, Buffett doesn't invest in all of them. He still says no far more often than he says yes. So what invisible filter has guided nearly every major investment decision he's made for decades? That's where the real lesson begins. Chapter 3. The Filter That Changed Everything. After Charlie Munger changed the way Warren Buffett looked at businesses, something else changed. Not what he bought, but what he ignored. Most people think great investors make money because they constantly find opportunities. Buffett became great because he became incredibly comfortable walking away from them. That sounds almost backwards. The financial world rewards action. Turn on financial news and someone is always telling you to buy, sell, or react. It creates the feeling that successful investing means always doing something. Buffett built his fortune by proving the opposite. Over the years, he has often repeated a simple idea. The difference between successful people and really successful people is that really successful people say no to almost everything. That wasn't just life advice, it was his investing strategy. Think about it. Thousands of public companies trade every single day. Buffett could invest in almost any of them, but he doesn't. He waits, sometimes for months, sometimes for years. To the outside world, that can look like inactivity. In reality, it's discipline. Most investors struggle with this because our brains are wired to confuse movement with progress. If we're checking prices every hour or constantly adjusting our portfolio, it feels like we're taking control. But activity isn't the same as intelligent decision-making. In fact, constant action often becomes expensive. Every rush decision, every trade made out of fear of missing out, quietly chips away at long-term returns. Buffett understood something that many investors never fully accept. You don't get paid for being busy, you get paid for being right. And being right often requires waiting much longer than most people are comfortable with. That's why Buffett has compared investing to baseball with one important difference. In baseball, if you don't swing, you get a strike. Eventually, you're out. But in investing, no one forces you to swing. You can watch opportunity after opportunity pass by without making a single move. There is no penalty for patience. The only requirement is that when the right opportunity finally appears, you recognize it. That mindset explains why Berkshire Hathaway has often held enormous amounts of cash during periods when everyone else seemed desperate to invest. Critics sometimes called him too cautious. Others said he was missing the market. But Buffett wasn't trying to participate in every opportunity. He was protecting himself from the wrong ones, and that's a completely different game. This is where his biggest investing lesson begins to take shape. His edge wasn't predicting the future better than everyone else. It wasn't having access to secret information. His edge was refusing to lower his standards just because everyone else was making money. But one question still remains. How did Buffett decide which businesses deserved a rare yes and which ones deserved an immediate no? The answer became one of the most famous ideas in investing, and it's probably much simpler than you think. Chapter 4. The question Buffett asks before every investment. If you asked most investors how they choose a stock, you'd probably hear answers like, the revenue is growing, everyone's buying it, or I don't want to miss out. Warren Buffett starts somewhere completely different. Before he thinks about the stock, he thinks about the business. And before he thinks about the business, he asks himself one simple question. Can I truly understand how this business makes money? It sounds almost too simple, but this single question has quietly protected Buffett from countless bad investments. He calls it staying inside his circle of competence. The idea isn't that you have to understand every company, it's the opposite. You only invest in businesses you genuinely understand. That means knowing how they make money, why customers choose them, and why they'll probably still exist 10 or 20 years from now. If Buffett can't confidently answer those questions, he doesn't invest, no matter how popular the company is, no matter how much everyone else is making. This is exactly why Buffett avoided many technology companies for years. It wasn't because technology was bad. It wasn't because he thought innovation would stop. He simply believed he couldn't predict which businesses would still dominate years into the future. So instead of pretending he understood something he didn't, he waited. Many people criticized him. Some even claimed he had lost his touch. But Buffett never felt pressured to prove he was the smartest person in the room. He only cared about making decisions he could understand. Years later, when Apple had evolved into a business with extraordinary customer loyalty, predictable cash flow, and one of the strongest ecosystems in the world, Buffett's view changed. He wasn't chasing a trend. He believed he finally understood the business well enough to value it. That's a very different reason for buying. Most investors ask, will this stock go up? Buffett asks, do I understand why this business should continue creating value? Those questions sound similar. They're not. One focuses on price, the other focuses on reality. And that's where most investing mistakes begin. People become experts on stock symbols, but never take the time to understand the companies behind them. They spend hours studying charts and only minutes studying the actual business. Buffett flipped that process upside down. The business always came first. The stock price came second. Once you understand that, another piece of the puzzle falls into place. But even finding a wonderful business wasn't enough for Buffett. There was still one final test, a test that caused him to reject far more companies than he ever invested in. And that final filter may be the most misunderstood part of his entire investing philosophy. Chapter 5. The final filter most investors skip. By this point, Buffett had stopped chasing cheap stocks. He had learned to look for exceptional businesses.
He stayed inside his circle of competence. So was that enough? Not even close, because Buffett knew something that sounds almost contradictory. A great business can still be a terrible investment if you pay the wrong price. This is where many investors get confused. They hear Buffett talk about amazing companies, then assume any price is worth paying. That's never been his philosophy. A house in the perfect neighborhood, great schools, low crime, strong demand, is everything you could want. But if someone asks you to pay 3 times what it's reasonably worth, is it still a great deal? Probably not. The quality of the house didn't change. The price did. Buffett approaches businesses the same way. He isn't looking for the cheapest company, and he isn't willing to overpay for the best one. He's looking for moments when a wonderful business is available at a price that still gives him a margin of safety. That phrase appears again and again throughout the history of value investing. Margin of safety. It's the idea that even if your assumptions are slightly wrong, you still have room to be right, because investing is never about certainty. No one, not even Warren Buffett, knows exactly what the future will look like. Companies face competition, recessions happen. A margin of safety acknowledges that reality. Instead of betting everything on being perfectly correct, it prepares for the possibility that you might be partially wrong. That's a completely different mindset than speculation.
Speculators often ask, how much money can I make? Buffett asks, what happens if I'm wrong? That single question has saved Berkshire Hathaway from countless bad decisions. It's also one of the reasons Buffett has never felt the need to chase every market rally. When prices become disconnected from reality, he waits. Not because he's afraid, because discipline matters more than excitement. Think back to some of the biggest market bubbles in history. Again and again, investors convinced themselves that this time is different. Prices kept rising, confidence kept growing, and anyone who stayed patient looked foolish until reality caught up. Buffett has often been willing to look wrong in the short term to avoid being wrong in the long term. That's a trade most people struggle to make because psychologically, waiting is uncomfortable. So is saying no when everyone else is saying yes. But Buffett understood something that most investors never fully accept. The market doesn't reward activity, it rewards discipline. And that's why his greatest investing lesson isn't really about finding the perfect company. It's about building a decision-making process that protects you from your own emotions. Once you understand that, the question that matters most stops being, what's the next hot stock? It becomes, does this investment truly deserve my capital? That shift sounds small. In reality, it changes everything. But there's one final reason Buffett has been able to follow this philosophy for more than 60 years, while millions of investors abandon it the moment markets become emotional. And that reason has almost nothing to do with money. Chapter 6. The advantage money can't buy. If you've made it this far, you might be thinking, so Buffett's real advantage was discipline. That's true, but even discipline comes from something deeper: temperament. For decades, people have tried to explain Buffett's success through intelligence, his memory, his ability to read financial statements. Those skills matter, but Buffett himself has repeatedly pointed to something else. He once said, success in investing doesn't correlate with IQ once you're above the level of 25. What you need is the temperament to control the urges that get other people into trouble in investing. Think about that for a moment. He didn't say the smartest investors win. He said the investors who can control themselves have the advantage. That's a very different game. Because the market isn't just a place where businesses are bought and sold. It's a place where human emotions are on display every single day. Fear, greed, regret, they all show up in prices, and they all try to influence your decisions. Two investors can look at the exact same company, same financial reports, same news, same information, and still react completely differently. One panics the moment the stock falls 20%. The other calmly asks, has the business actually changed? One is reacting to price, the other is evaluating value. That's the difference Buffett spent a lifetime developing. Take the financial crisis of 2008. While fear dominated the market, many investors rushed to sell simply because everyone else was selling. Buffett took a different approach. He looked past the headlines and asked whether the long-term value of strong businesses had actually disappeared or whether fear had pushed prices far below what those businesses were worth.
That mindset led Berkshire Hathaway to make several major investments during one of the most uncertain periods in modern financial history. The point isn't that every crisis creates buying opportunities. The point is that Buffett refused to let emotion make the decision for him. And that's much harder than it sounds, because our brains are wired to seek safety in the crowd. When everyone is buying, buying feels safe. When everyone is selling, selling feels safe. But markets don't reward comfort. They reward independent thinking backed by careful reasoning. This is why Buffett has never tried to be different just for the sake of being different. He simply refuses to let the crowd make decisions on his behalf. That's a subtle distinction, but it's one of the biggest reasons his approach has remained consistent for more than 60 years. When you step back and connect everything we've covered, a clear pattern begins to emerge. Buffett didn't build extraordinary wealth because he found a secret stock. He built it by following a process that filtered out bad decisions before they ever reached his portfolio. He chose businesses he understood. He waited for prices that made sense. He protected himself with a margin of safety. And above all, he kept his emotions from taking control. That's the lesson most people overlook, not because it's hidden, but because it's less exciting than chasing the next big winner. Ironically, that's exactly what makes it so powerful. So what does all of this actually mean for the average investor today? How can someone without billions of dollars, a team of analysts, and decades of experience apply Buffett's thinking in the real world? That's where the final chapter begins. Final chapter. The lesson that was never about stocks. It's easy to look at Warren Buffett's portfolio and think his success came from finding the right companies. Apple, Coca-Cola, American Express. Those investments are famous for a reason. But if that's all you take away from Buffett's career, you're looking at the outcome, not the process. Every investment you've seen was the result of thousands of decisions the public never noticed. The companies he refused to buy, the bubbles he stayed away from. That's the part most people never see. And yet, that's where his greatest investing lesson has always been hiding. Buffett never tried to predict what the market would do next week. He never built his reputation on making exciting forecasts. He built it by asking better questions than everyone else. Do I understand this business? Does it have a lasting competitive advantage? Am I paying a sensible price? And perhaps the most important question of all, can I stay rational when everyone else is becoming emotional? Those questions sound simple, but simple doesn't mean easy, because the market constantly tempts you to abandon them. Every headline tells you to react. Every market crash convinces you that everything is falling apart. Buffett's greatest advantage wasn't that he never felt those emotions. It was that he didn't allow those emotions to make his decisions. That's a lesson that applies far beyond investing. Whether you're building wealth or making important life decisions, the ability to stay patient, think independently, and focus on long-term value is incredibly rare, and rare qualities often produce rare results. So if there's one idea worth remembering from everything we've covered, it's this. Warren Buffett didn't become one of the greatest investors because he found extraordinary stocks. He became one of the greatest investors because he built an extraordinary decision-making process. The stocks changed over the decades, the economy changed, but that process remained remarkably consistent. And maybe that's why so many people miss his biggest investing lesson. They're searching for the next stock when they should be building the mindset that helps them recognize the right opportunity and, just as importantly, walk away from the wrong one. The market will always offer another headline, another can't-miss investment. The real challenge isn't deciding whether the market will give you another opportunity. It will. The real challenge is deciding whether you'll have the patience and discipline to wait for the opportunities that truly deserve your time, your attention, and your capital. Because in the end, the biggest investing lesson Warren Buffett ever taught wasn't how to beat the market. It was how to avoid letting the market beat you.